As a founder, do you understand your balance sheet? What is on it, apart from cash? What is on a balance sheet? What does it mean? Why should you look at it? Hi, my name is Alysha Randall. I'm a portfolio CFO from Fast Growth Consulting, and today I'm going to go through a balance sheet from a founder and startup and scale up perspective. So here's a balance sheet. I did go through the 3 financial statements, profit and loss, balance sheet, and cash flow at a high level in an earlier video. So I'll link that below. And I also did profit and loss last week. So if you want to go through that one, I'll also link that. So this is a very basic balance sheet. And then often there's a few extra things in here, of course, and I'll talk about those, but I just wanted to start with the bare bones. So it's called a balance sheet because your total of assets, in this example, it's 823,000, needs to be exactly the same as liabilities plus equity. So those two added together is 823,000. So at all times, if your general ledger is working and if you're using Xero or QuickBooks, they usually do. Usually the more sophisticated general ledgers, the more expensive ones, they may not because they're so flexible. But in general, it's very hard to get a balance sheet out of whack. If your balance sheet is ever not balancing, you may need to sack your entire finance team and start again. But essentially, that is why it's called a balance sheet. Okay, so we'll start with the assets because the easiest part to understand of a balance sheet is the assets. And generally, your assets are split into 2 categories. The first one being current assets, and the second one being either fixed assets or non-current assets. The difference between the two is how quickly you can convert it into cash. Roughly 30 days, give or take. So, these things can be converted into cash quite quickly. They're very liquid, and these ones less so. So obviously, cash is obviously a current asset. Cash can be converted to cash easily. So all of your bank accounts should be included in here. Bank accounts that have cash that you can access. So sometimes people think credit cards because it's associated with your bank. However, credit cards is not cash that you can access. You owe cash, so it's not an asset. Other things you could think about is, for example, if you have a digital business and you're using PayPal or Stripe or Super Payments or things like this, you may have a balance sitting with them that is yours, but it's sitting currently on their platform, and it's just taking a day or 2 or 3 to arrive into your bank account. This is also an example of cash. It's cash that is yours, essentially. Other very common things in here as part of cash that may be a separate item is deposits. So depending on how quickly you can add these, if it's like a rent deposit and you are you're locked into a 12-month contract, then deposits could potentially fall under here, or it can fall under here if it's a short-term deposit, like a credit card or something like this. I wouldn't stress too much with your understanding of whether it should be a current or whether it should be fixed. It's, that's your accountant's and bookkeeper's job. But just to give you a rough why they're in different categories. The next one is your trade debtors or, trade receivables. These are basically invoices that you've raised and should be, the other side will be sitting in revenue and it hasn't been paid yet. So ideally you want that cash or those invoices to be paid within 30 days. So that is your balance. So at any point in time, you can see how much customers owe you, and it's worthwhile keeping an eye on this one. So as a founder, keep an eye on this one over time. If it keeps increasing and not dropping very much, then I would question with your finance function about chasing those receivables or your sales team. Then we have prepayments. So nowadays, this is, I would say practically everyone would have prepayments. generally because, particularly with, say, SaaS products, you're paying for these upfront. So say, or rent even. So say, for example, you are paying for 3 months worth of a good or service. And what will happen is, in this example, this is at the end of January, the January element would not be here because you've spent that. That'll be sitting in your balance sheet, your profit and loss. But this amount here is things that you've paid for upfront, but you're not going to enjoy the goods or services of what you've paid for until after this date. So again, if you're paying for a huge amount upfront, and the amount that your customers owe you is getting quite big, then you would question your working capital because you're spending upfront for lots of things and it's costing you cash essentially, but your customers aren't paying you quickly. And so that is something to keep an eye on. Another very common one, and this is obviously not common with tech businesses, but certainly is with retail, and that is inventory. So anything that you're purchasing that is sitting in your warehouse or sitting in your 3PL that hasn't been sold yet as of this date, that would sit in here as well. And inventory management, I mean, that's a whole nother video. But managing your inventory and making sure that you keep the size of goods that are unsold manageable. I'm sure if you're a founder that is looking after a retail business or a wholesale business, you are well aware of that. But this is where you can see that information. So fixed assets, the most common fixed assets is a computer equipment, office and furniture, any tangible physical access that you can touch. There can be also intangible assets. So, for example, if you spend £100,000 on a website and you don't want to recognize that in the month that you purchased it, instead you want to recognize that over the life of the website. So say it's going to last you 2 years before you need an upgrade. You may want to put that in here in fixed assets and then just recognize 1/24th of it over a 2-year period. I did kind of explain depreciation at a P&L level in the P&L video just here. But essentially each different asset class, so here we have computer equipment, as I said, another one might be office furniture, less so now with lots of people working remotely. And another one may be, say, as I mentioned, intangibles. So it could be your IP, could be your website, and it could also be goodwill. So if you've purchased a company, and then this is the recognized goodwill. So each of them would have accumulated depreciation or amortization. Amortization is the same as the depreciation, but just with an intangible. So what this means is, say, for example, let's just talk about one asset. Say you've bought a £2,000 or $2,000 laptop in January, and then you want to recognize, you think that laptop's going to last for 3 years, 36 months. So every single month, your accountants will recognize £55 and 56 pence in the P&L, and then they would put the other side here. They would write it down. So by the end of the 36 months, in the example of the total here, you would have 25,000. You've paid 25,000 to buy all the computer equipment. Yet after, oh my gosh, after 36 months, you've written it off. So actually in the balance sheet, after 36 months, these computers would be worth nothing. So that's what accumulated depreciation is. It's just, it's like when you buy a car. You buy a car, say you're buying a brand new car, the second you drive it out the driveway, it's worth less. So, that would be an example. And then after 10 years or 5 years, sometimes your car will be worth nothing. And this is like personally, and this is exactly the same. So you can have even motor vehicles here if you purchase motor vehicles in your business. So any like physical asset. It could be land even. It could be a property. They don't usually drop in price though, but so you wouldn't have accumulated depreciation, but you certainly have it within here. And then intangibles, as I mentioned, you say you spent £2,000 on a website and then you want to recognize that over 2 years. So you just write it down over time. Goodwill is generally not written off. It depends on which country you're in. That is something you can talk about with your accountant. So depending on which country you're in and depending on what accounting standards, you either amortize it over time like you would with a website, or you revalue it every single year end. But that's nothing that you need to worry about when just reviewing your website, your balance sheet. So that's assets. There's obviously, you know, other things that can happen, whether it's investments in here or you know, if you're invested in another company, particularly if you have a subsidiary. So if you're the parent entity, you've got a subsidiary, you would have the investment in the subsidiary here, intercompany transactions, all those kind of things. But these are kind of the main ones. So that's your assets. So you have your assets total. Then you have liabilities. Now, I haven't here, but similarly within liabilities, you can have current and non-current liabilities. The most common non-current liability, of course, is a loan. So whether that's a convertible loan note, so if you're got fast growth business and you are fundraising, a convertible loan note would sit here, or a safe often sits here, another investment tool. But otherwise, it might be a loan from a government scheme, a COVID scheme, a bank, a lending provider, or asset finance. If you've got your computers on asset finance, for example. That is a very common loan. So generally with liabilities, it's anything that you have to pay within a year is a non-current liability. And then anything you have to pay longer than a year is a non-current liability. So what kind of liability? So as I mentioned, credit card balance. So this is how much you owe. Basically, that is what your liabilities are. How much do I owe other companies, other people? So trade creditors, that is just a total list, or trade payables is a list of all the invoices, unpaid invoices. So the opposite of your trade debtors. This is how much people owe you, and this is how much you owe other people. So, when you have to do a payment run every week, every fortnight, every month, you're going to be looking at these things. Credit card, as I mentioned, this is how much you owe. This is your balance on your credit card. Then we have employment costs, which you'll often see on a balance sheet. Now, the reason for this, so there's a couple of reasons. So when you do payroll, so say, for example, you do a monthly payroll on the 25th of every month. What you have to do is obviously pay your employees. So say you're paying your employees, I don't know, 50,000. And that is how much you transfer on the 25th. So you calculate your finance team calculate payroll. They work out that the net pay is 25,000. Oh, I don't know if you saw that, but I have to go and pick up the kids soon. I'm too far in to re-record, so hopefully that's okay. But anyway, so on the 25th, you have to pay your employees. So that is your net pay. But you also, and again, this depends on which country you're in, you also have to pay things like pension or 401k, health insurance, social costs, payroll taxes like NI in the UK, all these different things, income tax. So you may have, from your employees. So you may have had to hold back some tax and then pay it to the government. And generally, all of these things you don't have to pay until the next month. You don't pay it in the same month here. You have to pay it in the next month. So this balance should be how much have you do you owe all of these things from the month, say for this one, for the month of January, basically. I would say, put a caveat, in general, except for things when you're advancing employees, in general, this balance should only be for current month. And if this balance keeps growing and your employee numbers don't, and they haven't had a significant pay rise, then I would really question your finance team. They need to prove to you that this balance is only 1 month's worth. And then if it isn't, there must be a reason. I've seen way too often that this just keeps growing and growing and growing, or it goes into the negative. And it's because the accountants haven't done their job properly. So this amount should be just 1 month's worth. Then we have tax. So again, it depends on the country that you're in, but this could be like VAT, GST, sales tax. So again, at the end of January, say how much of the taxes you owe within the current month, but it certainly won't be owing. You wouldn't have paid it in months. So I would expect a balance to be in there every month. In this example, there isn't, but that's fine. And again, it should be very current. So this amount here in sales tax, VAT, GST, if you're paying it quarterly, then it shouldn't have more than say 3 to 4 months worth of tax owing. If you have corporate tax and you're profitable, then this would sit in your often it would sit in your non-current liabilities, depending on how regularly you have to pay it. There's obviously other bits and pieces. A director's loan would go in here, other creditors, but it's basically, if you think about it, it's basically what do you owe. So this is what do you own and who owes you, and this one is what do you own. Okay, the last one is equity. Now, this one is very long term, incredibly long term, and it's the beginning of time, basically. So the way that we can explain them, the first one is current year trading. So say, for example, your business's financial year is the same as calendar, which I know is very common in the US and the UK. And so in this example, we have got a profit and loss just for the January 24, was 8,000 before I played around with it. And this is a P&L for January. So this would be just 1 month of profit or loss. So, and then say on the 29th of Feb 24, you then say did a £10,000 profit, then this balance at the end of February in your balance sheet, you would have £10,000 plus 8,000. So your current trading is the year to date profit and loss of the business. And then let's say in the 31st of March, you didn't have a great month and you lost 2,000. Then then what would happen is that then your current year trading would drop to 16,000. So at any point in time, when you look at your balance sheet, you can see your year to date profit and loss. Your retained earnings is everything you did in prior years. So say you've been running for 10 years and you're in year 11, then this would be 10 years worth of trading. And in startups and scale ups, this one and this one is very commonly negative. If you're not, great, but doesn't mean it's wrong, but just think about your P&L. Have you had profits or losses throughout your period? So that's what those two are. Then we have share capital, and then you can have lots of different things like share premium, founders capital, lots of different other ways to invest. And all of this is what people have invested in your company. So in this example, £2 million, generally in cash, has been invested into your business. So whether that's you or investors or a combination of both, that is what this is. And then, of course, if you have, then you would have, say, for example, you would have your dividends, and that would make up then your equity. So hopefully that all makes sense. And again, I've kind of highlighted a few little red flags to look out for. But in general, if you ever wanted to know if your bookkeeping team is doing as they should, I do have a bookkeeping guide, and I'll put a link below where you can download how you can, usually it's the balance sheet. How can you find out that things aren't working? The P&L, you can also, because you know how the business should go, but essentially you want your finance team to have a really clean balance sheet. So this cash should equal exactly what's in your bank statements on that date. This should equal all of the invoices that are outstanding and you're actually chasing for them. This should, that should make up, okay, 40,000. I've got 5,000 with this supplier, 10,000 with this. You should know exactly what makes that up. Similarly, this should also be up to date. Depreciation should be run on a monthly basis. Trade creditors, this shouldn't have like negatives in here. It should be positive. Credit card should equal your credit card statement. A payment cost, just 1 month's worth. Loan should match your loan schedule. This should be year-to-date profits, and this should equal what has been invested in the business, which should be in your cap table. So they're all the things that you need to think about when looking at your balance sheet, but also looking at it, you can see, okay, this is how much cash we have. This is how much people are owing us. Do we need to chase that? This is how much inventory I have. Is it going out of control? Prepayments, is it, a manageable piece, or do we need to revisit our supplier negotiations? This is how much equipment and what have you we have, is it around the business? Is this the true valuation? Or are there things in here that shouldn't be, like things that aren't true assets, like a keyboard, for example. And then trade creditors, is this number getting out of control? Am I not paying my debts? Similarly with this one, is this also manageable? Are we, is it more than a month? So does that mean that we haven't been paying our employment costs in time, and is that a problem? Taxes, same kind of thing. Loan, this shows how much debt you have. Are you carrying too much? Are you not carrying enough? This gives us a good understanding of how you've traded over time and how much investment you've taken. So you can see from a balance sheet, you can really get a good feel on how the company is performing. It's not all on the profit and loss. The balance sheet certainly gives probably a bigger picture, and it also gives you good understanding of how you're tracking. Anyway, I hope that's been useful. Next week is the next one, cash flow. So I'll go through a cash flow statement and explain what you're looking at, what does it mean, and where are there, potential red flags. So thanks for watching, and I'll see you next week.